Here is what most people refuse to accept. The financial system runs in cycles, not random fluctuations, not unpredictable chaos, but identifiable, measurable, repeating patterns that stretch across decades. Simons understood this deeply. He believed that the biggest edge any investor can have is not information, it is the willingness to look at data without emotion, without bias, and without the desperate need to believe that this time will be different, because it never is. Right now, we are sitting at the end of one of the longest and most consequential debt cycles in modern history. The signals are not subtle. U.S. debt has surpassed $90 trillion in total obligations. Government debt alone stands at $38 trillion. That is 125% of the entire annual economic output of the country. And the interest payments on that debt now exceed $1 trillion every single year, which means the government is spending more just to service its debts than it spends on national defense or education. That is not a warning sign. That is a flashing red alarm that most people are too comfortable to look at directly. Simons would not look away. He would look closer. He would ask, what happens next? And more importantly, what do I do about it now, before the majority of people understand what is happening? The answer, based on historical data from every major debt crisis over the last century, points to 4 specific categories of investments, not dozens of strategies, not complex derivatives or leveraged bets. 4 clear, rational, evidence-backed types of assets that have survived and often strengthened during the most severe economic downturns in modern history. This video is about those 4, what they are, why they work, and how to approach them the way Simons would, systematically, unemotionally, and with a clear plan. Let us start with how the economy actually works, because without understanding the engine, you cannot predict when it is going to break down. Simons had a framework for almost everything. He did not accept conventional wisdom at face value. He asked, what is the underlying mechanism? When it came to the economy, he recognized 3 distinct forces at work simultaneously. The first is productivity, the real lasting growth that comes from human ingenuity, from doing more with less, from technology and innovation compounding over time. This is the foundation. It moves slowly, but it is real. The second force is the short-term debt cycle, which runs roughly 5 to 8 years. People borrow, spend, the economy heats up, interest rates rise to cool it down, borrowing slows, a recession clears the excess, and the cycle starts again. Most investors understand this one because they live through several in their lifetime. The third force is what most people never think about because it plays out over entire decades. The long-term debt cycle. Over many years, governments, corporations, and consumers all borrow more than they can comfortably repay. Each short-term cycle ends with slightly more debt than the one before. The borrowing gets normalized, it becomes policy, and then at some point, the accumulated debt becomes so large that even making the interest payments starts to crowd out everything else. Growth slows, options narrow, and the system reaches a moment of reckoning. We are at that moment right now, not approaching it, at it. When a long-term debt cycle reaches its terminal phase, there are only 3 ways out. The first is outright default. Borrowers stop paying, assets collapse in value, wealth is destroyed rapidly and brutally. The 1930s showed the world what that looks like. The second option is restructuring debts are renegotiated, lenders take losses, and the system reorganizes around a new lower baseline. This is less dramatic, but still deeply painful for anyone holding conventional financial assets. The third option, and the one central banks have chosen every single time in modern history, is inflation. Print money, lots of it, enough to dilute the real value of the debt, enough to make it manageable in nominal terms while quietly destroying the purchasing power of everyone who holds cash, bonds, or savings. They will not call it printing money. They will call it quantitative easing or economic stimulus or liquidity support. But the effect is always the same. The unit of currency buys less over time, savings erode in real value, and the people who do not understand what is happening watch their wealth quietly disappear while the official numbers tell them everything is fine. Simons would never accept that framing. He always looked at real returns, not nominal ones. He asked, after accounting for the actual loss in purchasing power, what is this investment actually worth? That question, asked honestly and consistently, changes everything. Now let us look at what history shows us. During the 1930s, the stock market dropped 89%. Bonds defaulted across multiple sectors. People who held conventional portfolios were devastated, but gold held its value and farmland continued producing income regardless of what was happening in financial markets. In the 1970s, a different crisis unfolded through inflation rather than deflation. Stocks and bonds lost enormous real purchasing power as inflation ran into double digits, but gold increased in value by approximately 24 times over the course of that decade. Agricultural assets and businesses that could raise their prices performed well. The pattern is not a coincidence. It is a feature of how economic crises actually work. With that foundation in place, here are the 4 investment categories that Simons' framework applied to historical data, economic cycles, and behavioral patterns consistently points toward as survivors. The first is physical precious metals, specifically gold and silver, held as physical bullion, not as ETFs or mining company stocks or collectible coins with inflated premiums. Physical metal, in your possession or in professionally allocated secure storage. Simons once observed something that most people find counterintuitive. He noted that the best insurance policies feel useless for long stretches of time. You pay the premium, nothing happens, and you start to wonder why you bother. Then the one event the policy was designed for actually occurs and everything changes. That is precisely how gold functions in a portfolio. During periods of economic stability and growth, it underperforms. It produces no dividend, no earnings, no cash flow. It just sits there. And people sell it out of impatience or because their advisor points to its lack of recent performance. Then a genuine currency crisis arrives, and the people who held on are protected while everyone else scrambles. Gold's entire function is to preserve purchasing power across time, independent of any government's monetary policy. It has done this for thousands of years across dozens of collapsed currencies and civilizations. That is not sentiment. That is an extraordinarily long data set pointing in one direction. The recommended allocation here is 10 to 15% of your liquid net worth held in physical form. Not more, because in stable times it does drag on overall performance. Not less, because when you need it, a 5% position will not move the needle. Reputable dealers include JM Bullion and similar established platforms. Allocated storage services like Bullion Vault allow you to own physical metal stored professionally without taking physical possession yourself. Expect to pay a premium of roughly 3 to 5% above spot price for gold, slightly more for silver. This is the cost of the insurance. The second category is businesses with genuine pricing power. This is where Simons' approach becomes particularly elegant because he did not think about stocks as pieces of paper with fluctuating numbers. He thought about them as ownership stakes in real operating businesses with real economic mechanics. During an inflationary period, most businesses struggle. Their input costs rise: labor, materials, energy, but they cannot raise their prices fast enough to compensate, and their margins get squeezed. However, a specific subset of businesses can do something powerful. They can raise their prices faster than inflation because their customers cannot easily go elsewhere or do without. Think about the companies that make products people buy regardless of economic conditions. Consumer staples, food, household products, personal care items, utilities, electricity, water, gas, healthcare, pharmaceuticals, medical supplies. These are not exciting sectors. They do not produce headlines or viral moments. They produce consistent cash flows and dividend payments decade after decade. Companies like Procter & Gamble, Coca-Cola, Johnson & Johnson, NextEra Energy, and Duke Energy have something in common beyond their sector. They have raised their dividends for 25 or more consecutive years through recessions, crises, and market panics. These are sometimes called dividend aristocrats. And the reason that matters is not the dividend itself, it is what the ability to sustain and grow that dividend says about the underlying business. It means the pricing power is real, the cash flow is durable, the business model does not collapse when conditions get difficult. Simons would look at the payout ratio, the percentage of earnings paid out as dividends. He would want it below 60%. That buffer means the dividend is not being stretched. The business has room to maintain it, even if earnings drop temporarily. He would diversify across 6 to 8 companies in these sectors rather than concentrating in 1 or 2, because even durable businesses face company-specific risks that data cannot always predict. These are not glamorous picks. They will not double in a year. But during an inflationary debt crisis, while speculative stocks collapse 50, 60, 70%, these businesses continue operating, continue generating cash, and continue compounding quietly for the patient investor. The third category is short-term government securities, specifically U.S. Treasury bills, with maturities ranging from 90 days to 2 years. This might sound unimpressive, but in Simon's framework, this category serves a specific and critical strategic function that most investors completely miss. Simons understood that a crisis creates opportunities. Asset prices collapse. Quality businesses become available at fractions of their real value. Real estate, stocks, even other businesses become purchasable at discounts that only exist during periods of widespread panic. But to take advantage of those opportunities, you need liquidity. You need cash or cash equivalents that are sitting safely on the sidelines, ready to be deployed when the prices are right. If all your capital is locked into illiquid assets during a crisis, you cannot move. You watch the opportunities pass. Or worse, you are forced to sell your own positions at the worst possible prices just to generate the liquidity you need for something else. Simons called this being trapped by your own portfolio. The solution is to maintain a meaningful allocation. He would recommend 20 to 25% in short-term instruments that are safe, liquid, and currently yielding somewhere between 4 and 5% while you wait. Treasury bills are backed by the full faith and credit of the U.S. government. They are available through Treasury Direct with no fees. They are available through brokerage accounts via ETFs like SGOV. They are available through money market funds and institutions like Vanguard and Fidelity. They are not exciting. They are not meant to be. They are your ammunition kept clean and ready for the moment when real targets appear. The fourth and final category is productive real assets, physical things that generate income, independent of what financial markets or monetary policy are doing. Farmland, rental properties, infrastructure assets. Here is the core logic. A piece of farmland produces crops. The crops get sold for whatever the prevailing prices are, which in an inflationary environment means they are being sold for inflating dollars. The real value of the land itself tends to hold because land is finite, food demand is inelastic, and no government printing press can conjure more arable soil. Rental properties function similarly. Rents adjust over time with inflation, providing a natural hedge, and the underlying property holds real value as a hard asset. Infrastructure assets, toll roads, pipelines, storage facilities often have contractual rate adjustments tied to inflation built directly into their business models. During the 1930s and the 1970s, while financial assets were being destroyed, farmland and rental properties continued producing income. The income amounts changed with the economic conditions, but the income did not stop. That continuity of production is the entire point. For most investors, direct ownership of farmland is capital intensive and requires specialized knowledge. The more accessible path is through REITs and farmland investment trusts that provide exposure to these asset classes with liquidity. Gladstone Land Corporation and Farmland Partners are examples focused on agricultural land. Realty Income is a REIT with 29 consecutive years of dividend growth that pays monthly. The Vanguard Real Estate ETF provides broad, diversified exposure. A 10 to 15% allocation in this category builds real asset exposure into a portfolio without requiring the complexity of direct property management. Now, here is the part that separates those who understand something from those who act on it. Simon's always said that knowing the right answer and executing on it are two entirely different problems. The behavioral gap, the distance between what investors know they should do and what they actually do, is where most wealth is destroyed. Not by bad analysis, by hesitation, procrastination, and the very human tendency to assume there is still time. The repositioning process he would recommend is methodical and staged, executed over 3 to 6 months, or longer if you are younger and have more time horizon available. The first step is honest assessment. Look at your current portfolio and ask one direct question for every position. Will this preserve purchasing power during an inflationary debt crisis? Not will it do well in a bull market. Not has it performed well recently. Will it hold value when the purchasing power of the currency is declining and conventional financial assets are under pressure? Anything that fails that test is a candidate for reduction. The second step is to begin selling speculative and vulnerable positions, first high-growth tech stocks with no earnings, long-duration bonds that get punished hardest by inflation, anything with high debt loads. That becomes dangerous when credit tightens. You do not need to sell everything at once. You do not need to time the peak perfectly. In fact, attempting to time the peak perfectly is itself a trap. The goal is directional movement over time, not a perfect single trade. The third step is to systematically build positions in the 4 categories as you free up capital. Physical metals first, since they are the simplest insurance to establish. Then shift equity exposure toward pricing power businesses. Establish the treasury position for liquidity, and begin layering in real asset exposure through REITs or direct ownership if you have the capital and expertise. The fourth step, and this one is purely psychological but critically important, is to write the plan down. Commit to specific allocations, specific timelines, and specific rules about what you will and will not do regardless of short-term market movements. The media will tell you the crisis is overblown. Your broker may discourage repositioning because their compensation is tied to keeping assets under management. The market itself may rally temporarily and make you feel like the concern was premature. None of that changes the underlying data. Simon's built his entire career on the discipline of following what the data said, not what felt comfortable in the moment. Many investors will read something exactly like this and still not act, not because they do not understand it, because human psychology resists change, especially when the immediate environment still feels normal. The crisis at the end of a long debt cycle does not announce itself dramatically at the start. It creeps. It moves gradually through official statistics that get revised and explanations that sound plausible until suddenly, within months, the magnitude of what is happening becomes undeniable. By that point, the repositioning window is closed. Simon saw this pattern play out repeatedly. Brilliant, sophisticated investors who understood the risks intellectually but could not bring themselves to act early enough. The cost of that delay was not a minor reduction in returns. In debt cycle collapses, conventional portfolios have historically lost 50 to 60% of their real value. If you are 40 years from retirement, that is painful but survivable through time and compounding. If you are 5 years from retirement, it is potentially catastrophic, a forced delay, a reduction in lifestyle, a fundamental alteration of plans that cannot be reversed by waiting. The data suggests we are now in the late stage of this cycle. Interest payments on government debt exceeding defense spending is not a statistic that exists in healthy economic environments. It is a terminal indicator not of imminent overnight collapse, but of a system that has run out of room and is approaching a forced resolution. The resolution will take one of the three forms described earlier. And the form it takes, most likely the inflationary path, has clear historical precedents with clear winners and losers. The question is simply which side of that divide you choose to be on before the choice becomes obvious to everyone. Before we close, if you found this analysis valuable, leave a comment below with one specific action you are going to take this week based on what you learned here. Not a vague intention, a concrete step. Whether it is reviewing your current portfolio against the purchasing power test, researching a specific REIT, or opening a Treasury Direct account, write it down publicly. That commitment matters. And if this way of thinking about wealth, cycles, and data-driven decision-making speaks to you, subscribe and hit the notification bell so you do not miss what comes next. Let us close with the essential summary. The economy operates in long cycles, and we are at the end of one of the most extended debt cycles in history, a point confirmed by debt levels, interest payment burdens, and the historical precedents of what always follows. When long debt cycles end, central banks inflate. When they inflate, conventional portfolios in stocks and bonds lose real purchasing power. Four categories of assets have survived and protected wealth through every historical precedent of this type of crisis. Physical precious metals as insurance, businesses with durable pricing power as inflation-resistant equity, short-term government securities as liquid strategic reserves, and productive real assets as income-generating hard asset protection. The execution requires a staged, written, committed repositioning plan carried out over months, not impulsive moves made in panic. Simons never operated on hope or intuition. He operated on patterns, evidence, and the discipline to act on conclusions that data made clear, even when the broader world had not yet caught up. That gap between what the data shows and what the crowd believes is exactly where rational, prepared investors build enduring wealth. The cycle is not waiting, and neither should you. The financial system runs in cycles, and right now, we're at the end of the biggest debt cycle in modern history. $38 trillion in government debt. $1 trillion just in interest payments. The warning signs are flashing red. Most people won't act until it's too late. But history always rewards the prepared. In this video, we break down the four investment categories that have protected and grown wealth through every major crisis using the same data-driven thinking as the greatest investor of all time. Simple, clear, and actionable for everyone. Write in the comments the one investment move you're making this week to protect your wealth. Let's hold each other accountable. Gold investing, debt crisis, 2025, how to protect wealth from inflation, best investments during recession, financial crisis investing, treasury bills, dividend stocks, precious metals, farmland investing, REITs, economic collapse preparation, inflation hedge, wealth preservation, smart investing, financial freedom,